Commercial banks are an indispensable element of any functioning market economy. They have two principal tasks. First, commercial banks facilitate the transfer of payments between private households, companies, and government entities. As cash only plays a minor role in our everyday lives, banks organize a large part of our monetary dealings through electronic transactions. This means without any banknotes or coins involved. The purpose is the exchange of economic goods and services for zero money or the settling of financial obligations. Companies pay wages, taxes, contributions to social insurance systems, suppliers' invoices, etc. electronically. Private households transfer rents and pay their gas and electricity bills via their Giro accounts. Everything we pay by credit card is also debited from our accounts. All of these money flows are made possible by the bank's transfer of payments. Banks also have a second important function: to act as financial intermediaries for people and businesses that save money and those that need loans. In this context, commercial banks fulfill a number of functions. Their most important functions as intermediaries are the pooling of assets, maturity transformation, and the risk transformation for savers and providers of capital on the one side, and for borrowers and investors on the other. Let's take a closer look at these functions. In the case of the pooling function, the bank does the following. It accepts medium, smaller, and even very small savings deposits and bundles these small volumes into larger or even very large loans. In the case of maturity transformation, the bank balances time horizons. On the one side, you have savers that plan to withdraw part of their money in cash in the foreseeable future, or that transfer funds from their accounts to pay bills. On the other side, you have people that want to build a house with a loan, or a company that wants to make an industrial investment with borrowed money. These debitors plan to repay the loan over a period of many years or even decades. Therefore, only a small portion of the money lent flows back to the bank every month. A condition for the functioning of the maturity transformation of banks is that they have to have sufficient liquidity. Finally, banks transform many types of risks. This is true when granting loans and also for other types of financial transactions. The focus here is on the risk of default of a debitor or of a counterparty. By carefully evaluating potential borrowers and widely diversifying the savings deposits invested, the bank minimizes the risk for small savers and guarantees the full repayment of the amounts deposited. Additionally, for a certain premium, banks are willing to assume the risk of interest and exchange rate fluctuations and of commodity price fluctuations. This is how, for example, many airlines protect themselves against higher fuel prices. This is also part of the risk transformation function assumed by banks. A large number of customers and transactions make it possible to diversify maturities and risks. The aim of prudent lending is therefore to diversify both maturities as well as the risks as widely as possible.